Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and back again, starting with a macro debrief as we do most weeks. So let's look at what went on this week. We had the JOLTS job openings. That came in at 7.39 million versus an estimated 7.11 million. We had non-farm payrolls, which came in higher than estimated as well, 139,000 versus the estimated 126,000. And we had unemployment rate, which came in line with consensus and what was estimated at 4.2%. I guess with these three data points, the big takeaway here is that the labor market has been stronger and more resilient than perhaps what was expected. And obviously these numbers paint a much better picture in comparison to what the consensus estimates were, but it's not as flowery as it may seem. I think it's important to note that there has been a trend downwards over the last year. There was a 625,000 decline in the labor force as well, meaning that those people aren't even considered unemployed because they're not part of the labor force. So yes, while these numbers do look good, the bigger picture still shows deterioration over time. It's just maybe not as bad as what we may have expected given all the macro tension. But all this, I guess, to reinforce and say that I really don't see a need or a reason to rush cutting rates at this point. Despite all the pressure that's coming in from the president, I think Jay Powell and the Fed has time to wait, and seemingly they will do so. They're probably going to wait to see a little more pain in the market before they start easing rates, just to be cautionary with regards to inflationary implications from tariffs or other policies. I guess in other news last week, we had some drama as well, which is again more or less noise, but Musk versus Trump, right? That was a big drama towards the latter half of last week. What did it mean for Tesla? Well, on Thursday, that was 17% drop, approximately a 17% drop in the stock price, followed by about a 4% gain by end of day Friday. The market, I've said this before, but the market is just way too headline driven, and at the moment I do tend to worry, is Tesla a stock that's worth its risk at the moment? Musk, has he bitten off more than he can chew with all this involvement in the government? Is he, him talking about the bill, calling it disgusting? Is his personality, I guess, worth the risk of owning the Tesla stock? And that is a question that, I've been asking myself. Like, the stock has done pretty poorly this year in comparison to some of the other peers in the Mag 7, and I think there was a lot of hype baked into Musk being close to Trump when Trump got elected, and that's a big reason as to why Tesla performed so well. But fundamentally, the company has just not been doing well enough to justify the valuation, in my opinion. And I think the loss of sales in Europe, the loss of sales in China, losing out to some Chinese EVs, they seem to have a lot of headwinds coming their way. But obviously the tailwinds are things like humanoid robots and robotaxis, and that event is coming up soon. So I guess there are things to look for with regards to Tesla, but given Musk's track record and history of over-promising and under-delivering, I'm struggling to see how that robotaxi event is going to go in the grand scheme of things, and whether monetizing it is going to be able to justify the current growth valuations that are baked into the company. I think another piece of news was Trump and his meeting with Xi, or his call with Xi, and which will eventually hopefully turn into a meeting. Again, don't want to get too much into detail, but something that's important to note is the outcome. And the outcome has been that Trump is going to visit China and Xi will visit the White House. So, hopefully deals to be hashed out there. But again, no point diving into political nuances. It's just best to play a wait and see game. Important to keep in mind, but I think by playing this wait and see game and by understanding these data points with better probability, we can keep an outlook on whether deals will be made or not and what the implications are on the markets and companies that maybe are of interest to us and maybe have a more strong supply chain in China. In other news, the S&P is up to 6,000. It's up 2.25% year to date. Now, I say this with a bit of cautionary optimism, but this obviously touching 6,000 is a bullish view, right? But I guess under such market conditions, it's better to tread with caution. There are risks of pullbacks, and because we're in a headline-driven market, reaction to any negative or negative-ish news can be larger than expected. And for me, in such moments, I'd perhaps want to put money in a VIX ETF, such as VIXI, just as a short-term hedge. And if there is a spike in volatility, I'd sell the position after a specific percentage point gain. But just as a short-term hedge to market volatility and uncertainty, especially as we approach Liberation Day 2.0, it might be better off to just consider some sort of hedge to your portfolios in general. But that covers the macro debrief, and now to move on to earnings. There are a couple companies this week. I think the main focus is going to be on the two consumer defensive companies, Dollar General and Dollar Tree. So let's start with Dollar General, a classic beat and raise. Shares were up almost 16% on Tuesday after earnings announcement. EPS came in at $1.78 versus what was expected to be $1.48. And revenue came in higher than expected as well at $10.44 billion versus what was expected to be $10.31 billion. Customer traffic was down slightly, but they spent more each visit. Now, Dollar General has done very well this year. Stock is up about 50% year to date. Clearly investors see Dollar General as a beneficiary of the potentially inflationary environment, right? And that works. That makes a lot of sense. The CEO, Todd Vasos, said that the company has worked to reduce its exposure to China and, hopes to limit price hikes for shoppers going forward. So I guess even the way they want to, protect the consumers who are more likely than not financially strained is something that bodes well with investors, bodes well with the consumer in general. And another positive that came from them was in inventory management and operational improvements, right, which led to a 5% year-over-year reduction in merchandise inventories. Strong cash flow from operations was up 27.6%, up to $847 million. Early repayment of $500 million in senior notes, and they've obviously strengthened their balance sheet, and they're doing good things, I guess, operationally to support long-term shareholder value creation. And on top of that, they're growing. They're investing in new stores, 56 new stores in Q1. They're expanding their delivery capabilities. They're accelerating their Project Elevate and Renovate models for the more mature stores, which is basically a makeover for the more mature stores. So this strategy has been working for Dollar General, and they're doing well, and the market has been rewarding that with the 50% year-to-date gain. The big takeaway for me here from this entire call was the fact that Dollar General claimed that they drew more middle and higher income shoppers. This is unusual for a company, a discount retailer like Dollar General, but obviously I think consumers being driven by fears of tariffs and consumer sentiment being at an all-time low in April, we it makes sense that maybe some of the more affluent or middle and higher income shoppers are spending in discount stores, and that probably also explains why there's been more expense per visit from customers. If Dollar General can tap into that demographic effectively and sustain the demand that it's facing, it would expand its addressable market hugely. As I mentioned, most of the consumers are those that are financially constrained. So if they can expand that demographic, they're going to be able to squeeze more out of each customer on average per visit. There were some guidance adjustments which worked really well for the company. They now anticipate net sales will grow about 3.7 to 4.7% compared to previous expectations of about 3.4 to 4.4%. So that was the raise there. And they expect diluted EPS to range from 5.2 to 5.8 compared to the prior outlook of approximately 5.1 to 5.8. So a slight raise there as well. They anticipate same-store sales or comp sales to increase 1.5% to 2.5%, which is higher than previous guidance of about 1.2% to 2.2%. So overall, a pretty solid quarter, a solid beat and raise for Dollar General. And, markets are seeing that and rewarding that as well. I think, another company similar to Dollar General was Dollar Tree, another discount retailer. They also posted solid results, but the stock was down about 11% at some point on the day of the announcement. Main reason for this was guidance, a weak second quarter adjusted EPS view, which, obviously would have hurt investor sentiment, especially after Dollar General earnings, which Dollar Tree was also up on the day of Dollar General's earnings. So stock has been up about 23.5% year to date, not as much as Dollar General. But, there are obviously differences in the business, and there are nuances to why things are being priced as they are. Dollar Tree, strong Q1 results, exceeding the high end of its outlook for comparable store sales, net sales, and adjusted EPS. The strong results were driven by a 5.4% increase in comp sales. Traffic was up 2.5%. So actually in their case, traffic was up, and average ticket prices were up 2.8%. So, they displayed also robust performance across both the consumables and discretionary categories. On top of the financial growth and strong results monetarily, they added 2.6 million new customers in Q1. And again, much like Dollar General, notable growth from higher income households. So households that are classified as having more than 100,000 per year, an income of more than 100,000 per year. So they saw a 9% increase in customers visiting 3 times a month or more. Their market share gains accelerated, especially in immediate consumption and some key discretionary categories. On top of all that, the sale of Family Dollar is on track to close in early summer. Now, this is expected to strengthen their balance sheet, of course, and cash position. About 800 million net proceeds with 350 million tax benefits. An investor day is also planned for October 15th. And this is hopefully to provide a refreshed long-term strategy and outlook for the company. I do think the sale of Family Dollar is a good thing for them. It enables Dollar Tree to focus on its core, higher performing banner and accelerate strategic initiatives, such as their store remodels, multi-price expansion, and operational improvements. In my opinion, I think after this earnings call, perhaps this is one of the good consumer defensive plays at the moment, that maybe have not baked into, maybe don't have the kind of growth baked into, or the optimism baked into the stock price as a company like Dollar General. If your outlook is that the average consumer is going to want serious discounts in the near future because of, whether it be inflationary pressures or, just worsening consumer sentiment because of increase in unemployment, then I actually think Dollar Tree might be a good play at the moment. Guidance was timid, right? But that pessimism after that 11% drop or whatnot last week is already relatively baked into the price. This business is becoming more lean. They're becoming more focused. The macroeconomic factors may actually help to drive customers to Dollar Tree stores. It may actually be a catalyst in this business finding its foot again. And I think, definitely this would be a company of interest for me at the moment, and perhaps one that, investors should look at too, more so than Dollar General, because I think a 50% increase in stock price for Dollar General year to date already bakes in a lot of optimism into the stock price. Now, the last company I wanted to talk about was, it was not a consumer defensive, it's a growth tech play. It's called MongoDB. Right now, they reported earnings, but before we get to earnings, what does MongoDB do? They're a type of database, essentially, which is like, think of it like a digital filing cabinet, where businesses can store their data and information. But, unlike the traditional way that filing cabinets, have fixed folders and labels, the way MongoDB lets you store information is in a much more flexible way. So this essentially means that companies, can easily add new types of data and information without having to reorganize everything or ensure that everything is in the right place per se. The use case for this, it's specifically good for handling, lots of different kinds of data quickly, like big data, and can grow easily as the business gets bigger. If an example of this would be if an app needs to store user profiles, messages, photos, and locations all together, MongoDB is able to handle all that smoothly. Many big companies use MongoDB to keep their apps running and, to manage their data without much of a hassle. So, in short, the company helps businesses store and organize their data in a way that's, convenient, simple, and fast, and easy to change as the businesses grow. So going to their earnings, right, they reported strong Q1 results with revenue of $549 million, which is up 22% year over year and above guidance. So Atlas, their cloud database platform, revenue grew 26% year over year, and it now represents 72% of total revenue. Their non-GAAP operating income was about $87 million. It was $87 million, a 16% margin, and net income was $86 million, $1 per share. Gross margin was 74%, slightly down due to Atlas mix and the Voyage AI acquisition. The company added approximately 2,600 customers sequentially, reaching over 57,100 total customers. And, from that, self-serve customer additions were particularly strong and were the highest net adds in over 6 years. They raised their guidance for fiscal year 26, so another beat and raise, and revenue is now expected to come in between $2.25 billion and $2.29 billion, which is up $10 million. Non-GAAP operating income is expected to be between $267 million and $287 million, and non-GAAP EPS is expected to be between $2.94 and $3.12. So Q2 revenue guidance is between $548 million and $553 million, and the stock is up almost 17% this week. So a massive jump for the company post earnings, and to reinforce, I guess, confidence in their business, the board expanded the share repurchase program to $1 billion, right? And this reflects that confidence in long-term growth. The company remains focused on upmarket expansion, obviously AI-driven innovation, and, operating efficiency. And, with Atlas, the growth is stabilizing, and, they're gaining strong enterprise traction. Now, my thoughts are that in a day and age where data is incredibly important, right, which is the day and age we live in today, the handling of data is equally, if not more important, right? And MongoDB as a business solves a very real and important problem, one that most likely every business is bound to have. because every business is going to be dealing with data of some sorts, right? Yes, MongoDB are not profitable at the moment. It's definitely not going to be one of those value plays that people are looking for, but revenue growth is extremely strong, right? Negative earnings, negative ROE do raise some concerns, yes, and valuation relative to peers is high. But I guess the question is then whether you think this kind of business, and MongoDB specifically, warrants that kind of premium. It is a solid company. It does have an effective product offering that has grown in revenue, margins, and customers. So it's definitely one that I'll be keeping an eye on as potential interest, and one I suggest most of you keep an eye on as well. But that pretty much wraps it up for this week's episode. I would like to remind you guys that, again, none of this is formal investment advice. It is all purely for educational and informational purposes. So when I say that I like a company, or I would like to buy a company, it's more for educational purposes than formal investment advice. Please take what I'm saying with a pinch of salt and do your own research. With that, I thank you all for listening. I'm Anurag Birla, and this is the Finance Now podcast.